Gary Peltier was 63 years old, retired from 28 years working maintenance at a paper mill in rural Wisconsin, and he had never once been late on a tax return. He kept his records in a manila folder in the second drawer of his kitchen desk. He paid his bills on time. He saved his money the way his father taught him, cash in hand, deposited when you had enough to feel safe. He was not rich, he was careful. So, when the letter arrived from the Internal Revenue Service on a Tuesday morning in February, Gary read it 3 times before he understood what it was saying. The IRS had flagged his checking account. Not for tax fraud, no, it wasn't about that. Not for unreported income either. Everything was legal. For the way he had been depositing his own money. That is the part that stops people cold. Every single time. He had not done anything wrong. Not in the way most people mean when they say that. He had not hidden income. He had not lied on a form. He had simply been depositing amounts just under $10,000 every few weeks, the same way he had always done it. The same way his father had done it, because that is what felt manageable and safe to him. And without anyone ever telling Gary that this pattern had a name, without anyone warning him that this name carries federal consequences, his account had been quietly reported to the federal government multiple times over the course of 14 months. Think about what that means. The bank never called him. The bank never sent a letter. The bank never said a word. The reporting happened in the background, invisible, filed without his knowledge and without his consent, because the law not only allows that, it requires it. That is not a hypothetical. That is the system working exactly as designed. Now pay attention here, because what I am going to walk you through today matters whether you have been banking the same way for 30 years or whether you opened your first savings account last month. There is a framework the federal government uses to monitor the movement of money through American bank accounts. And the thresholds that trigger that monitoring are not what you think they are. The number most people have heard, $10,000, is only the beginning. The number that actually catches people like Gary, people who have done nothing wrong, is lower. And in 2026, the tools being used to watch those numbers have gotten significantly more powerful. I am going to show you exactly how this works. I am going to name the specific amounts that put your account under a microscope. And I am going to give you a clear, practical plan for protecting yourself and your money before this becomes something you deal with firsthand. Before we get any further, if this channel is not already on your subscription list, fix that right now. Every video here is built around giving you the kind of information that protects you before you need it, not after. Go ahead and tap subscribe right now. And then drop a comment below telling me what state you are watching from. I read every single one, and it helps me understand what laws and rules matter most to the people watching. Now let me walk you through the foundation of all of this, because without understanding it, nothing else I tell you today will make full sense. In 1970, the United States Congress passed a law called the Bank Secrecy Act. Plain language version, that law made it a legal requirement for banks to help the federal government track large cash transactions. It was aimed at drug dealers and organized crime figures who were moving enormous amounts of cash through American banks without any paper trail. The idea was straightforward. If someone deposits or withdraws more than $10,000 in cash in a single day, the bank files a report. That report is called a Currency Transaction Report, or a CTR. It goes directly to a division of the Treasury Department called the Financial Crimes Enforcement Network. You may never have heard of it. It has heard of you. That is the $10,000 rule that floats around in public conversation. And for decades, people figured out that if they just kept their deposits under $10,000, no report would be filed. What those people did not know, what Gary Peltier did not know, is that the government figured that out too. Congress responded by making that very behavior a federal crime. The crime is called structuring. Structuring means deliberately breaking up transactions to avoid triggering the $10,000 reporting requirement. And here is the part that should stop you cold. You do not have to be trying to hide anything for structuring to apply to you. Federal courts have ruled, repeatedly, that the source of the money does not matter. The intent to avoid the reporting threshold is enough. So if you are depositing $9,800 every few weeks because that is what you have on hand, or because it feels tidy, or because that is just how you have always done it, the pattern itself can be treated as evidence of intent. Gary was not hiding drug money. Gary was not laundering anything. Gary was depositing his own legitimate savings in the amounts that felt natural to him. And he was doing it in a pattern that the Bank Secrecy Act was specifically designed to flag. And that is the part nobody tells you until it is too late to matter. The number that catches most people is not 10,000. It is the number just below it, repeated often enough to form a pattern that automated systems are built to recognize. And the systems doing that recognizing in 2026 are not the same systems that existed even 5 years ago. What those systems look like and what specific amounts are now drawing federal attention in ways they were not before, that is where we go next. $10,000 is the number everyone knows. It is not the number you need to worry about. The Bank Secrecy Act set that threshold in 1970. It has never been adjusted for inflation. If it had been, the trigger today would be somewhere around $78,000. But Congress never updated it, and the IRS never pushed to change it. Because a lower threshold means more reports, more data, and more visibility into how ordinary Americans move their money. That is not an accident. That is a policy choice. And here's the thing. The $10,000 currency transaction report is almost the least of your concerns now. In 1994, federal regulators introduced a second reporting instrument called the Suspicious Activity Report, or a SAR. Where a CTR is automatic, any cash transaction over $10,000, filed without exception. A SAR is discretionary. Your bank's compliance officer looks at your account activity, decides something looks unusual, and files a report without any threshold at all. There is no minimum dollar amount. There is no specific pattern required. If the activity in your account strikes a trained compliance officer as inconsistent with your normal behavior, inconsistent with someone in your profession, or inconsistent with the type of account you hold, a SAR gets filed. And just like the CTR, you will never be told. The $3,000 rule sits underneath all of this, and almost nobody talks about it. Federal regulations require banks to record, not necessarily report, but record, the identity of any customer involved in a cash transaction of $3,000 or more. That record is kept on file and is accessible to federal investigators without a warrant under the Bank Secrecy Act framework. So the idea that your transactions are private unless they cross $10,000 is not accurate. The documentation trail starts at $3,000. Now pay attention here, because this is where 2026 changes the picture in a way that did not exist even 3 years ago. The IRS and the Financial Crimes Enforcement Network, FinCEN as it is known, have both made significant investments in artificial intelligence and machine learning systems designed specifically to analyze transaction patterns across millions of accounts simultaneously. These are not systems that wait for a bank employee to notice something. They run continuously, automatically against aggregated banking data, looking for patterns that human reviewers would never catch at scale. Deposits that cluster just below reporting thresholds, timing patterns across multiple accounts, cash flow that does not match your reported income profile, transfers between accounts that suggest layering. That is the practice of moving money through multiple accounts to obscure where it came from. Gary Peltier was not layering anything, but the pattern of his deposits, amounts between $8,500 and $9,700, made roughly every 3 to 4 weeks over 14 months, is precisely the kind of pattern these systems are built to surface. To an automated system, a pattern like that, and a pattern created by someone deliberately structuring transactions to hide income, look identical. The system does not know your intentions. It sees the shape of the numbers. And what happens after the system flags you is where this stops being abstract. Civil asset forfeiture is a legal process that allows the government to seize property, including money in a bank account, before any criminal charges are filed, and in some cases without ever filing charges at all. You read that correctly. The government can take your money, and the burden falls on you to prove that the money was legitimately yours in order to get it back. Not on the government to prove you did something wrong, on you to prove you did not. The Institute for Justice, a nonprofit legal organization that tracks forfeiture cases nationwide, has documented hundreds of cases where ordinary Americans had accounts seized based entirely on cash deposit patterns, with no underlying criminal activity ever established. The average amount seized in structuring-related forfeiture cases has historically been under $35,000. Not the accounts of wealthy tax cheats, but the accounts of small business owners, farmers, and retirees, who handled cash as a normal part of their financial lives. Randy Sowers is one of the most documented cases. He was a Maryland dairy farmer who had his entire business checking account, over $62,000, seized by the IRS in 2012 based on a pattern of deposits under $10,000. Sowers had no criminal history, his income was legitimate, his taxes were filed. The IRS eventually reached a settlement and returned a portion of his money, but only after years of legal proceedings and significant legal costs. He was never charged with a crime. That is not an isolated story. It is a documented pattern of enforcement that disproportionately hits people who deal in cash. Farmers, restaurant owners, and contractors, and retirees who grew up in an era when cash was simply how you handled your money. Gary Peltier grew up in that era, and what Gary did not know, what the bank was legally forbidden from telling him, even as they filed the reports, is the part of this system that makes the whole thing feel like a trap designed for people who never saw it coming. That silence is not a gap in the system, it is a feature of it. And understanding exactly what your bank is required to keep from you changes how you think about every deposit you make from this point forward. Your bank knows something about you right now that it is not allowed to tell you. That is not a figure of speech, it is a provision of federal law. Under the Bank Secrecy Act and the regulations that govern suspicious activity reports, it is a federal crime for any bank employee, from the teller who processed your deposit to the compliance officer who filed the report, to notify you that a report has been filed on your account. The legal term for this prohibition is tipping off. If your bank's compliance department decided last Thursday that your deposit activity looked unusual and filed a SAR with FinCEN, and you walked into that same branch on Friday and asked the branch manager directly whether any reports had been filed on your account, that manager is legally prohibited from telling you the truth. Telling you would be a federal offense, is carrying potential criminal penalties. Let that sink in. You have no right to know. You have no right to respond. You have no right to explain yourself before the report is filed. The process moves entirely in one direction, from your bank to the federal government, and you are the last person in that chain who will ever be informed. And this is where the system gets significantly more complicated in 2026, because the definition of what counts as a reportable transaction has quietly expanded, far beyond the walls of your bank branch. If you use Zelle to pay your contractor $8,000 for a renovation, that transaction passes through the banking infrastructure and is visible to the same compliance systems your direct deposits run through. If you use Venmo or Cash App for regular payments that form a pattern, weekly transfers to a family member, monthly payments to someone who helps with your property, those platforms are now required under updated IRS reporting rules to issue a 1099-K for transactions that cross $600 in aggregate annual payments to a single recipient. $600. That threshold dropped from $20,000 in previous years. And the platforms feeding data into that reporting framework include PayPal, Venmo, Cash App, Zelle, and any other third-party payment network that processes more than the minimum volume. Now, I want to ask you something directly. Drop an answer in the comments right now. Do you use Zelle or Venmo for regular payments? Payments to family, to contractors, to anyone you pay more than once? Because if you do, and those payments follow a consistent pattern, that pattern is now part of the same data picture that compliance systems are designed to analyze. Subscribe if you have not already, because what I am about to tell you next is something the platforms themselves have no incentive to explain clearly. Joint accounts carry the full reporting exposure of both account holders. If your spouse deposits $9,000 in cash, and you deposit $8,500 in cash in the same 30-day period, those transactions are associated with the same household and the same account. The combined pattern is visible to compliance systems as a single financial profile. The same applies to business accounts, where you are a signatory. Your business deposits and your personal deposits can be analyzed together when investigators pull the full account picture. And here is what most bank customers have never been told about the Know Your Customer rules that every American bank now operates under. Know Your Customer, KYC in banking shorthand, is a federal regulatory requirement that obligates your bank to build and maintain a profile of who you are, what your normal financial behavior looks like, and whether your actual transaction activity matches that profile. When you opened your account, your bank assigned you a risk category. You almost certainly do not know what that category is. And every transaction you make either fits the expected pattern for your category, or it creates a deviation that the compliance system flags for review. If you are a retired school teacher and you suddenly begin receiving 3 cash deposits per month, averaging $8,000, that deviation from your established profile can trigger a SAR, regardless of the dollar amount, because it does not match who the bank thinks you are financially. The source of the money is irrelevant to the trigger. The deviation is the trigger. The legal safe harbor in this framework is not a specific dollar amount. It is documentation and consistency. Federal guidance makes clear that customers who can demonstrate the legitimate source of their cash activity, business records, sales receipts, payment logs, estate distributions, settlement documentation, are significantly harder to pursue under structuring laws because the pattern has an explanation that predates any investigation. The documentation has to exist before the question gets asked, not after. After is too late. what that documentation looks like in practice, and how ordinary people build it without hiring an accountant or an attorney is simpler than it sounds. And paired with one specific account structure decision that takes about 20 minutes to set up, it takes the pattern of your deposits off the list of activity that automated systems are designed to surface. The number that makes the difference, the account move that changes your exposure, and the documentation habit that protects you if anyone ever does come asking. That is what closes this out. And if Gary Peltier had known what I am about to tell you, the letter that arrived on that Tuesday morning in February would never have been written. The number is $2,000 exactly. That is the maximum amount financial security experts and consumer protection attorneys consistently recommend keeping in a standard checking account at any given time. Not because checking accounts are unsafe, but because a checking account is not a storage vehicle. It is a transit point for your money. Money comes in, covers your bills and your immediate expenses, and moves out. What sits in a checking account beyond what you need for 30 days of living expenses is not being protected. It is being exposed to unnecessary risk. Think about what that means practically. If your monthly expenses run $3,500, mortgage or rent, utilities, groceries, gas, insurance, then the working balance in your checking account should stay somewhere in the range of $4,000 to $5,000 at most, enough to cover the month with a reasonable buffer. Everything above that number has a better place to be, and moving it there is not complicated. A high-yield savings account at a federally insured institution keeps your money accessible, keeps it earning interest at rates that in 2026 are still meaningfully above what a standard checking account pays, and puts it in a separate account with a separate transaction history. That separation matters. Compliance systems analyze transaction patterns within accounts. When large sums move from a savings account to a checking account to pay a specific bill, that movement has a clear and visible purpose. It does not generate the kind of pattern, repeated cash deposits of similar amounts with no obvious corresponding expense, that triggers a structuring review. If you have more than $30,000 sitting in a single checking account right now, I want you to hear this clearly. That money is not working for you. It is sitting in the highest visibility, highest exposure account type in the American banking system. It is currently generating almost no interest for you at all and creating a transaction footprint that automated compliance systems are specifically designed to monitor. You need to move it right now. Not all at once, not in a way that itself creates a sudden, anomalous pattern, but deliberately and with a destination in mind. Treasury bills, short-term government debt instruments that you can purchase directly through treasurydirect.gov are one of the most underused tools available to ordinary Americans for parking cash safely. They are backed by the full faith and credit of the federal government. They mature in periods as short as 4 weeks, and the interest they generate is exempt from state and local income tax. Purchasing treasury bills does not trigger bank reporting requirements because the purchase moves money from your bank to the Treasury Department directly. That is not a loophole. That is the system working as intended for people who use it. Money market accounts at federally insured banks and credit unions offer another layer of separation with full liquidity, meaning you can access the money when you need it, while keeping the balance out of the checking account transaction pattern that draws automated scrutiny. Now, here is the documentation habit that takes less than 10 minutes a month and could be the difference between a minor inconvenience and a federal inquiry. Keep a simple running log of any cash you deposit, not a formal accounting document, a plain note dated that records where the cash came from. Sold furniture on Facebook Marketplace for $800 on the 14th. Received a cash payment from a tenant for November rent on the 1st. Got paid in cash for weekend work on the Henderson job. That log, kept consistently over time, is evidence of ordinary, legitimate financial activity. It costs you nothing. It is not submitted to anyone. It sits in a folder or a note on your phone, and it exists as documentation that predates any question anyone might ever ask. If you are ever contacted by the IRS or by a bank compliance officer about your deposit patterns, the correct response is 3 things: calm, cooperative, and documented. You do not volunteer information beyond what is asked. You do not explain your entire financial history unprompted. You provide the documentation that shows the legitimate source of your funds. And if the inquiry goes beyond an initial conversation, you involve a tax attorney before you say another word. That is not obstruction. That is your right. Gary Peltier eventually resolved his situation. It took 11 months, 2 written responses to IRS correspondence, and a meeting with a tax attorney who helped him reconstruct a paper trail that had always existed in receipts, in a pension statement, in a side income from selling firewood off his property, but had never been formally organized. No charges were ever filed. His account was never seized. But he spent 11 months not knowing whether the money he had saved over 30 years of careful living was going to be taken from him by a system he had never heard of, for a pattern he had created without any criminal intent. Gary is a composite of real people, men and women whose stories came across my research over the past several months. People who dealt with IRS correspondence, bank compliance flags, or structuring inquiries based on deposit habits they had held for decades. His name is not real. His situation is. That situation is not rare. And the people it happens to are almost never the people the system was designed to catch. They are Gary. They are the person who taught Gary. They are, with very little variation in the details, someone you know. If someone in your life banks the old-fashioned way, deposits cash, keeps a running balance, never thought twice about the amounts, send this to them right now. Not later. Right now, before you close this out. One share to one person could save them from 11 months of what Gary went through. If this gave you something real to work with today, hit the like button. It tells me this kind of information is worth continuing to put out. And if you are not subscribed yet, do it now. This channel exists for exactly this reason, to give you what the system was never going to explain on its own.